All right, guys, welcome back to the channel. So today is episode 88, and today I'm going to do something a little bit different. We're going to talk about pretty much my process for building wealth using three ETFs. All right, so if you guys don't know what an ETF is, it's an exchange traded fund. And pretty much what it is, it's a group of stocks that's in a particular fund that's managed. You are charged a management fee, but the benefit of having ETFs is you don't have to manage the stocks yourself. For example, if you own Microsoft and you invest heavily in Microsoft and Microsoft goes down, then you have to look at the appropriate action that you would like to take. This is all managed by managers of the fund, and as a result of that, it's managed for efficiency. So you get maximum return. You do pay a small fee, but you don't have to do any of the management yourself. Traditionally, these three ETFs have really good returns. When I'm talking about returns, I'm talking about annualized returns. So on average, they give about the standard, I would say, stock market return, which is roughly around 10% on average. But then you have some which will go as high as 30 something percent in a year. So it's a good way to kind of like set it and forget it. I invest two different ways with these ETFs. So I have them on like autopilot or cruise control, whatever you want to call it. So funds are automatically taken out of my account on a weekly basis and invested into these three ETFs. That's one way. The other way is, as you guys know, I'm slowly trying to grow my long-term investments using options. So whenever I get an option play and I'm profitable, I usually take about a third of that and buy into stocks. And primarily, I'm using a third of that to buy these three ETFs. So we're going to go over these ETFs today, explain why I choose these ETFs, and I'll give you some basic information on how they work. This is just what I buy. There's a bunch of different ETFs out there, but I prefer to stick with these three, and I'll give you guys my reason and my logic behind it. So let's get into the video. All right, so the first ETF up on the screen, as you guys can see, is the S&P 500 ETF, the Spider, ticker symbol SPY. Currently, it is sitting at $506.79. If you look at it over max time, you can see it just continuously goes up. Just like any other stock, it has its ups and downs. It's not a straight line. It's not just like a linear line going all the way up, but it's definitely, if you look at it, it's just constantly going up over time. Over max time, you guys could see it is up 273%. And if you look at when the fund initially started back in, I believe this was, what is this, like 2000? That's as far back as Robinhood goes with it. But I believe this ETF actually started back in 93. But we'll get to an information card and we'll put that up on the screen with definitely all the specifics. But as you can see, from 2000, it was $1.63 per share to where it is now today, which is $506. Crazy, crazy, crazy return. All right. So we're going to go ahead now and just scroll down and take a look at some of the industries that actually make up the SPY. All right. So here we are in Robinhood and it says what is in the fund. So as you guys can see, 30% of the SPY is made up of technology stocks. Then the next sector here, we have financial services. So this is like your banks, healthcare, pharmaceutical companies, that type of stuff. And we have consumer cyclical, which is pretty much just like restaurants, auto parts stores, that type of stuff. And we have 9% allocated to communication services. So as you can see with SPY, you get a pretty much broad coverage of all the major sectors. This is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. And they are 11 different sectors. So pretty much you get exposure to all the sectors. Obviously, the smaller sectors are like real estate and utility. But you have everything in here. You have energy, which is the oil companies. You have industrials, which covers defense stocks as well as, industrial companies. Then we have communication services. So you would have like Verizon. So it's definitely an ETF that you can invest in and have a broad exposure to the market. Now, there's a bunch of different other ETFs, but in my experience, SPY is the number one. It is the top dog. It has the largest amount of assets under management in terms of like dollar value. And we'll go over that when we get into the informational card. So year to date so far, it is up 7%. The last year, it was up 22%. 22%, that's huge. All right. And then over 5 years, it is up 72%. And as I showed you guys before, over max time, it is up 273%. So let's go ahead now and hop into the information card on SPY. All right, so here we have the SPY ETF information card up on the screen. So these are just some basic facts that you guys should know. So it's called the Standard & Poor's Depository Receipts. Were launched by Boston asset manager State Street Global Advisors, SSGA. Okay, and this was back in January 22nd of 1993. It is definitely the oldest ETF, probably the first ETF, right? As the first exchange traded fund in the United States. So in the United States, it was the first ETF. In February of 2024, SPY became the first ETF in history to reach $500 billion in assets under management. That is phenomenal. Phenomenal, like huge. All right. Average annual return is 10%. The rule of 72 states it would take 7 years to double your money at this rate of return. So pretty much the whole idea behind investing in ETFs is, like I said, you don't have to manage multiple stocks. You invest in this. The average return over time has been 10% per year. But as I showed you guys, the last year it returned 22%. All right. So the SPY ETF expense ratio is just 0.09%, which is $9 charged for every $10,000 invested. All right. Now there's a bunch of different ETFs with a much lower cost. Just be careful. ETFs, when they started getting really popular, they were popping up out the woodworks. Everybody was trying to do something to get some type of fee, and everybody just kept shaving the fee down. As you can see, SPY is the big dog. This is what all the rich people invest in. This is all the big corporations put money into this. This is where it's at. If you don't own SPY, I don't know what you're doing with your life. This is one of the ETFs you definitely want to own. Don't pay attention to the fee. Look at the returns over time, and also pay attention to the assets that they have on the management. Not too many companies, not too many ETFs can claim even a number close to half of this. And that's a whole fact. To be eligible for S&P 500 index inclusion, a company should be a U.S. company, have a market capitalization of at least 8.2 billion, be highly liquid, have a public float of at least 50% of its shares outstanding, and its most recent quarter's earnings and the sum of its trailing 4 consecutive quarters' earnings must be positive. So as you see, these guys have a requirement for you to be inside the ETF. They don't just let any old company in there. I've seen ETFs and they're like, oh, we have 3,000 companies. Yeah, I'm good. You don't need that. This is what you need. If you're looking for overall good market exposure, this is the ETF. There's a bunch of different other ETFs, but when you compare them side by side, none of them meets the performance that SPY has done. They don't. I'm sorry. They just don't. So now off to the left here in the green, we have the dividend yield information. So it says SPY has a dividend yield of 1.34% and has paid $6.72 per share in the past year. The dividend is paid every 3 months, and the last ex-dividend date was March 15 of 2024. So if you own SPY March 15, 2024, or before that date, you would be getting a dividend when they pay out next. All right. So that's it for SPY. Let's move on to the next one. All right. So the next ETF that I invest into heavily is QQQ. As you guys can see, over max time right now, QQQ has a 400% return on investment over max time. 400%. That is just crazy. If you go back to when it started, or when it was on Robinhood, I would say, back when they started taking that information in, this was back in 2000. They have it at 0. I don't know why, but let's say, let's go to April of 2000. It was $8.88 per share. From 888 to where it is now, which is 429, that's massive, massive, massive gains. So next, let's go ahead and scroll down and take a look at the different sectors that make up the QQQ. All right, so here we are, what's in the fund. So QQQ is heavily influenced by tech. As you can see by this blue bar here, this entire section here is technology. 49% of QQQ is made up of technology stocks. So we're talking Microsoft, Apple, Amazon, all the big tech stocks are in QQQ, which is why if you guys pay attention to how I trade, whenever there is, let's say, positive earning for one of these major companies, you can always guarantee that QQQ is going to go up. So heavy on tech. The next up, 15% is communication services. Then we have consumer cyclicals at 12, almost 13%. Consumer defensive, 6. Healthcare, 6. Industrials, 4. Basic materials, utilities, financial services, energy, and then real estate. So QQQ, like I said, is heavily, heavily influenced by technology. So if you're into technology, this is the ETF that you want to own. I personally own it because I do have a technical background in terms of, computer programming, web development, that type of stuff. So I actually like QQQ for that reason. The other reason I like it is the crazy returns. So if we look at QQQ right now, year to date, QQQ is up 5.91%. But if we look at it last year, it is up 33% over the past year. 33%. That is crazy. That means if you had put $100 in, you'd have $130 now. That's crazy, crazy gains. Another thing I want to tell you, if you pay attention to the breakdown of QQQ and then you look at some of these super investors, their portfolio pretty much just mimics what's in the QQQ. Over 5 years, it is up 125%. And over max time, as I showed you guys before, it's 400%. There's very few ETFs out there that can beat the SPY in terms of returns, but QQQ is one of them. Now, QQQ does have years where it goes down, and that's why you kind of want like SPY to kind of balance it out. You understand what I'm saying? You don't just want to be heavy QQQ, or it makes good gains. You want SPY because SPY has some tech too, but it has a good overall coverage of pretty much all the major sectors in the stock market. So you'll get balance. So if QQQ goes down, because as you see, about 50% of it is in tech. If tech has a bad year or a bad couple of months, your portfolio will still be up because you're also invested in SPY. So that's the way I do it. All right. So now we're going to go ahead and hop into the information card for QQQ and just get into some of the specifics as far as the dividend, the fees, when the fund started, and all that stuff. All right, so here we have the information card up on the screen for the QQQ ETF. QQQ began trading in 1999. So SPY started in 93. QQQ started in 1999. This is probably, I would say, probably the second or the third oldest, right? And there's a theme here. The reason why I'm choosing these particular ETFs is because they've been around for a while. They last. They have money. You know, you have a lot of fly-by-night ETFs, man. I've seen ETFs come and they get all this hype. A prime example is the Kathy Woods ETF, ARK, ARKK. There was all this big hype, how much it was returning, and all of that was based around Tesla. When Tesla was doing good, it was doing good. Soon as Tesla started to fade away, just look at ARK. It's like every different time segment that you click on for Robinhood, the return is negative. So if you had put a bunch of money into ARK, you'd have lost your money. So I'm not trying to go find the newest, hypest ETF of VTQQY and all this other craziness. I want to stick with the fundamentals and the stuff that works. And that's why I'm in the SPY. And now, as I'm showing you guys, I'm heavy in QQQ as well. All right, so as of August 2023, the fund had 200 billion in assets under management, and among its top holdings were Apple, Microsoft, and Amazon. Heavy on tech, like I said. But notice this, just like I told you guys, SPY is the big dog. SPY is 500 billion. They're not even at 50% of what SPY is managing. They're at 200 billion, but that's still an impressive number. But I'm just trying to show you the magnitude of SPY. So SPY to me is number one, and then QQQ would be number two. A portion of its fund's assets under management is charged to investors as a fee, currently at 0.20%. So they have actually the highest fee out of all the three ETFs that I currently invest in. But like I said, you look at those returns, kind of balances it out. Since inception, QQQ has returned an annual average of 9.7%. So when you add up all the years that it's been out, and you divide it up by the total return over max time, it's about 9.7%. But like I said, you have years like last year where it was up 33%. All right, so now let's look at the average return, QQQ versus SPY. So in the past year, QQQ returned a total of 31.70%, which is significantly higher than SPY's 22.17 return. Over the past 10 years, QQQ has had annualized average returns of 17.98% compared to 12.27% for SPY. These numbers are adjusted for stock splits and include dividends as well. All right, so on the left here, we go into the dividends. QQQ dividend yield. QQQ has a dividend yield of 0.63% and paid $2.64 per share in the past year. The dividend is paid every 3 months, and the last ex-dividend date was March 18, 2024. So if you own QQQ before March 18, expect a dividend soon. All right. And that's it for QQQ. Now we're going to go ahead and hop into the final ETF that I invest in. So the next and final ETF that I invest heavily into is ticker symbol SCHD, which is the Schwab US Dividend Equity ETF. Currently, the price is $77.35. And over max time, as you guys can see, it is up 209%. If you go back to when it started, which Robinhood actually has the right date on this, it is back in 2011. And back in 2011, the price was roughly around 50 cents. Imagine that, from 50 cents to where you are now, which is $77.35. So I invest in this stock, this ETF, primarily just to get some exposure to the dividend ETFs. Now, at one point, I had owned another one, which was called NOBL, Noble. But when you compare, Schwab has, I believe, a better fee. and it outperforms the Noble ETF. The Noble ETF is primarily based around the dividend kings. Schwab is just based around any company that pays dividends, pretty much. We're going to go ahead now and just scroll down and just look at the different sectors that is included in this particular ETF. All right, so what's inside the fund? As you can see by the different sectors here, the biggest one is financial services at 17%. Next up, we have healthcare at 14%, consumer defensive at 14%, industrials at 13%, energy at 13%, consumer cyclicals at 10%, technology at 8%, communications at 4%, and then we have basic materials at pretty much 2%, and utilities is not even 0.5%. But so as you can see here, you get like, I would say, a nice mix as well. But again, this is focused heavily on companies that pay dividends. So you're going to have your Coca-Colas, your Pepsis, your Procters and Gamble, just all those heavy dividend stocks that necessarily don't move that much in terms of stock price. They don't move as fast as, say, like tech companies, but they pay a nice dividend, and they've been paying a dividend for a while. So this is what this ETF does. It pretty much just manage, these stocks so you don't have to manage them. At one point, I remember I had a bunch of dividend stocks, and I had this big spreadsheet, and it was just a little bit too much. I could just take whatever money that I made off my options and allocate a portion towards this ETF, and it pretty much just takes care of everything for me. Yes, I pay a small fee, and it is a small fee because of the 3 ETFs. This one actually has the smallest fee. So let's go ahead and get into the information card right now. All right, so here we have the information card up on the screen for the SCHD dividend ETF. So the fund's inception was October 20th of 2011. Total net assets as of May 1st, 2024 is 53 billion. So they have 53 billion assets under management. Total expense ratio is 0.060. So like I said, the smallest of the 3. The Schwab US Dividend Equity ETF, SCHD, historical returns in the last 10 years. The Schwab US Dividend Equity ETF, SCHD, obtained a 10.91% compound annual return. So when we compare it against the other popular dividend ETF, which is Noble, NOBL, it says here SCHD performance comparison as of year to date. Both investments have demonstrated similar returns, with Noble at 1.92% and SCHD at 1.92%. Over the past 10 years, Noble has underperformed the SCHD with an annualized return of 10.27%, while SCHD has yielded a comparatively higher 10.96% annualized return. So in terms of dividends now, SCHD has a dividend yield of 3.47% and paid $2.67 per share in the past year. The dividend is paid every 3 months, and the last ex-dividend date was March 20th of 2024. So if you own SCHD before March 20th, expect a dividend payment shortly. All right, and that's pretty much it, guys. Those are the 3 ETFs. Like I said, with SPY, I get exposure to the overall market. With QQQ, I get heavy exposure to tech, which grows like crazy. Yes, it does have its pullbacks, but when tech is moving, it moves. And I am focused on putting my money into stocks and ETFs that move. All right. These 3 ETFs, I own them for myself, and I also own them for all my kids. So every one of my kids have money that comes out of my account every week, and it goes into these 3 ETFs. So like I said, you have a bunch of different options. You could do your research. You could do, look at the fees and, look at all the companies that they own, but pay attention to the overall return of the ETF over max time, and look at what they return year to date, as well as the last year, over 5 years, and you will see that these guys are the top dogs. Also, I trade these stocks with the exception, these ETFs, with the exception of SCHD. I trade SPY on a regular. I trade QQQ on a regular. I know how these stocks move. When I make, let's say I make $300, I could take $100 and split it up between these three ETFs. I also, because I trade SPY and QQQ heavy, I also know the levels. So I'm constantly averaging it into these ETFs. I know when it's, at support, and I know when it's at resistance, and I can buy at whatever level that I want to buy it or sell at whatever level I want to sell it. But if you're looking for a way to invest without having to watch every stock or own 100 different companies, you can't go wrong with these three ETFs. Like I said, with SPY, you get exposure to the overall market. QQQ, you get exposure to fast growing tech. And with the SCHD, you get exposure to pretty much all the major dividend payers. All right. But that's it for the video today, guys. I hope you found this information useful. If you did, please consider subscribing. I make new videos like this every day. Please go ahead and also like this video if you found the information useful. Also, towards the end of the video, you will see two videos pop up on the screen. Please go ahead and check those out as well, and share this video with a family member or friend. Thanks again for watching the video. Y'all have a blessed day. Peace.